CrowdStrike is a high quality cybersecurity company that has crushed the market since it came public in 2019. However, this high growth software company is currently down more than 47% from its 52-week high. While shares are still really expensive in absolute basis, we actually think that right now is a great time to start a position in this high growth business. Why? We'll explain all of that next. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Common Stock for supporting today's video. As of the time of this recording, both Brian and I are already shareholders of CrowdStrike.
So Brian, even though CrowdStrike is down over 40% from highs, it's still a $36 billion company.
CrowdStrike's mission is to protect our customers from breaches. This is simple, inspirational, and optional. Man, do I love this mission statement.
I do too. So how does the company do this? Well, as you mentioned, this is a software as a service cybersecurity firm. They offer now 22 different tools that help protect companies from breaches.
CrowdStrike has done a phenomenal job at attracting customers ever since this business was launched, and as of the most recent quarter, it had more than 17,000 total customers on its platform.
Among those customers are some of the biggest in the world, including over half of the Fortune 100 and Fortune 500.
CrowdStrike's annualized recurring revenue growth has been nothing short of spectacular, growing more than 61% in the most recent quarter to nearly $2 billion.
And look at this, the company's dollar-based net retention rate has stayed above 120% for a long time, and perhaps more importantly, its gross retention rate continues to get closer to 100%, currently at above 98%.
So how does CrowdStrike make money? This is a software as a service business that attracts new customers and convinces them to expend more. As we just showed, this company's dollar-based net revenue retention rate in the most recent quarter was 124%, which is a very strong number on an absolute basis.
Now, customers are expensive to acquire, so that's one thing to note. However, this is one of the few categories where we think customer demand is robust. It will be in demand no matter the macroeconomic cycle, and the majority of revenue is recurring.
So does CrowdStrike have a moat? We think the answer is yes. The more customers this company signs up, the more endpoints it has to protect from attacks. The more attacks that it encounters, the smarter its engine gets to protect all of its customers from attacks. Therefore, the bigger its network gets, the more it protects all of its customers from future attacks. That's a strong network effect.
Of all the charts that might convince you to invest in CrowdStrike, to me, this is the most convincing. It shows the number of tools that customers are using. Those with 4, 5, or 6 plus tools are in the blue, red, and yellow. And as you can see, those with at least 5 or 6 tools have just about doubled over the past year. The more tools that are added, the higher the switching costs and the greater the evidence that the company does have optionality.
Beyond the network effect and switching costs, we also think there's some value in the brand name CrowdStrike. It has become the top dog in its space, and we think it resonates within the IT community.
The company did have a counter-positioning advantage when it started as the first cloud-native cybersecurity firm. That has largely dissipated since, but it doesn't take away from the fact that the moat is expanding around the company.
So how have the financials looked? In a word, great. Revenue growth over the last 3 years has compounded at a 65% annualized rate. Gross margin on a GAAP basis is well over 70%. And while net income on a GAAP basis has been negative, net income on an adjusted basis is positive.
And that shows through when we look at free cash flow, which has been positive and growing for a number of years now. The balance sheet is stellar, and we believe those returns on capital will turn positive soon.
Turning to management, CrowdStrike was founded by George Kurse, a cybersecurity veteran many years ago, and he's still the founder and CEO today.
Employees love working at the company, giving Kurtz and the company high marks, and insider ownership is pretty high, with Kurtz owning most of that, 6.8% of the company, over $2 billion today.
So what about optionality? Well, CrowdStrike's own history of rolling out new products shows us that this company has optionality in spades. Given the growing demand for cybersecurity tools around the world, we think this will remain true going forward.
When we look at operating leverage, there's a lot of room for the company to improve in the years ahead. The addressable market is large and growing, and CrowdStrike has just captured a small portion of it, and most of its growth is organic, although it has made a few acquisitions lately.
So how has CrowdStrike done for investors since it came public? The answer is great. This stock is up over 160% from its IPO, and management has a history of smashing Wall Street's targets.
Unsurprisingly, CrowdStrike is not focused on giving cash back to shareholders right now. They're focused on their own growth.
Sounds great so far, right? Well, there's a whole bunch of potential risks that investors need to be aware of if they're going to invest in CrowdStrike alongside us. First and foremost, foremost is competition. The cybersecurity industry is rife with competitors, and CrowdStrike is squaring off against companies like Fortinet and SentinelOne. So competition is the number one business risk that investors need to be aware of.
Beyond that, you should be aware that if you're buying shares, there's a good chance that you're going to be diluted. While this is not uncommon for fast growing young tech companies, it is something to keep an eye on.
We actually think that this is a fairly low risk business. However, the stock is a different story, and that's mostly due to the valuation. We'll have more to say on the valuation in a little bit.
And with cybersecurity, there is always the added caveat that if its tools get hacked or cannot protect its customers, that would be game over. There's no way you can predict it, but that's the price of paying in this field.
Yeah, reputation risk is a massive long term risk for all cybersecurity investors to be aware of.
So, how did the company do when they recently reported their first quarter? The answer is really good. Revenue grew at 61% and beat both Wall Street's and management's own expectations.
They also reported 31 cents in adjusted earnings per share on the bottom line, which blew past Wall Street's targets and management's own guidance.
On a GAAP basis, gross margins improved to 74%, while operating and net margins were negative, though that was largely because of stock-based compensation.
Free cash flow remains positive and continues to grow. Net income on an absolute basis did decline, and the balance sheet remains stellar.
So, what about looking forward? Management guided in the second quarter for $515 million in revenue. That's 52% growth and ahead of Wall Street's estimates at the time.
Management's guidance on the bottom line is calling for 28 cents in adjusted earnings per share. That also bested Wall Street's target.
And when we look at the full year, that growth rate should continue. Management upped its guidance for the fiscal year to 52% growth. That was ahead of Wall Street's expectations.
Management believes it's going to produce about $1.20 in earnings per share on an adjusted basis for the full year. That was also ahead of Wall Street's target.
So what should we watch moving forward? Well, first and foremost is the multi-product usage. The company will break down how many customers are using 4, 5, 6, and just recently 7 tools. Keep an eye on that.
Second, watch the dollar-based net revenue retention rate. This is a key metric for all SaaS investors to watch, and so far, CrowdStrike has been killing it here.
Third, keep an eye on operating margins, especially sales and marketing. That's a huge expense for the company, and we hope that it declines as a percentage of revenue moving forward.
Fourth, watch free cash flow. So far, CrowdStrike has turned into a free cash flow machine, and we want to see those rates continue to compound higher over time.
Overall, we believe that the moat is widening around this company, and the thesis for investing in it is very much on track.
So how did CrowdStrike score on our investing checklist? The answer there is great. I recently ran it through, and it continues to score in the 80s, which is well into my high-quality business category.
And this also lands in the anti-fragile category on my framework, scoring a 12.5.
So what about the company's valuation? Well, first, let's consider where this company is likely to be in its growth cycle. The numbers indicate to us that the company is clearly in the hypergrowth stage, so it's focused on revenue growth first and foremost and profits later. Therefore, since management is so focused on revenue and gross profit, the price to sales and price to gross profit ratio are likely to be your best guides, although management is starting to focus on operating leverage, so in the not too distant future, the price to earnings ratio and the price to free cash flow ratio will become more relevant.
Speaking of that, let's look at these metrics. On a price to sales ratio, CrowdStrike trades for about 21 times. That is very high when compared to the market at large, but historically, that's at a fairly reasonable valuation for this company.
The price to gross profit ratio for CrowdStrike is currently hovering about 30. That's also very high in absolute terms.
Now, let's not forget that CrowdStrike has been producing growing free cash flow piles. And if we look at the price to free cash flow, it trades for about 75 times that number. Again, high on an absolute term, relatively low on historical term for CrowdStrike.
And if you look at the forward price to earnings ratio, which CrowdStrike does have, shares are currently trading for about 128 times that number. In no world is that considered cheap, but that is one of the lowest rates on record for this business.
So that's why we're buying shares of CrowdStrike for our shared portfolio. Now you can follow us along over on Common Stock.
We're going to be posting these slides in the next few days, and we encourage you to go there and add a public comment letting us know what you think of our decision to buy CrowdStrike today.
Every week we look through the comments on those postings and we pick out the most insightful one. It doesn't have to agree with us. In fact, we love it when people push back. And the winner will get $250 from Common Stock.
Congratulations to Connor Value, who made the top comment on our slides that we posted about our decision to buy Datadog last week.
Connor will be getting $250 from Common Stock. Thanks, Connor.
So there you have it. In the next couple of days, we'll be buying $250 worth of CrowdStrike stock in our public portfolio, which you can follow on Common Stock. Let us know what you think of the video below. Brian's out.